Hi everyone, welcome to the Real Estate Tax Tips channel. My name is Cherry Chen. I am a chartered professional accountant located in Ontario, Canada. My mission is to become the Google map for hardworking Canadians seeking financial freedom. Today we're going to talk about the tax implication when you move into your rental property. Now before I get too much into depth, every week I send out an email about money saving tips and real estate tax tips, all designed to help you build your long-term wealth and live life on your terms. The email takes 5 minutes to read and over 10,000 Canadians get it. Love to have you check it out, totally free, unsubscribe whenever you want, but think you'll like it. Sign up using the link below. Recently, many of my clients have asked me about the tax implication when they move into their rental property. Some clients are in transition, staying in their rental properties until they move into their permanent home, and some have decided to just move into their rental for good. You may not be aware of this, but every time you change the use of a property, whether it is from primary residence to rental property or from a rental property to primary residence, you are considered to have sold the property at its fair market value. You're also considered to have acquired the property for the same amount. Fair market value of the property is based on the time of change. Now, let me use an example to explain this capital gain tax implication. Using an example to explain, you buy a rental property worth $500,000 and then you rent it out for a few years. And then one day you decide to move into it. At the time of moving in, your property is valued at $600,000. In this case, you're deemed to have disposed of your property at $600,000, hence making a capital gain of $100,000. Even though you never sold the property, you may be triggering a capital gain tax on the $100,000. Now, let's look at two scenarios. Scenario number one, no capital cost allowance claimed. As some of you may have known, CRA allows you to claim capital cost allowance against your net rental income, allow you to deduct the wear and tear of your building and defer that amount to future years when you sell the property. If you have never claimed capital cost allowance before, in this scenario, it's beneficial for you. If you have never claimed capital cost allowance against the rental income from prior years before you move into the property, you can elect to defer the capital gain, the $100,000 in my example, until you sell the property to a third party with a proper tax election. And the tax election's name is 45-3 election. Now, scenario number two. If you have claimed capital cost allowance, say you've claimed capital cost allowance on the property against net rental income. You did this just so that you can offset some of the rental income from previous years and then you can save the taxes. So you claim it. In this case, unfortunately, the election is not available for you. So you're required to report the $100,000 capital gain the year that you move into your property. Additionally, you would also have to add all the accumulated capital cost allowance that you claim, also known as recapture, that you've claimed over the years to your income in the year that you move into the property. So in most cases, our clients are caught off guard by the unexpected tax bill. To qualify for this 45-3 election, you cannot claim capital cost allowance on the property for any tax year after 1984 and on or before the day you change its use. This election should also be filed together with your tax return when you eventually sell this property. As a bonus to this election, assuming you qualify, you can also designate this property as your primary residence for up to 4 more years before you actually occupy it as your primary residence. Now, assuming you don't have any other property designated as your primary residence during these 4 previous years, what does that really mean? Let us look at this example. You work in Toronto, currently renting a condo, making good money. However, Toronto house price is just going crazy. And so you venture out and decide to buy a property in your hometown, Hamilton, as an investment property. Your family lives in Hamilton and is an easy commute for you. Maybe one day you would move back to Hamilton, who knows? You bought your investment property and started renting it out for the next 5 years. 5 years later, you got a job offer in Hamilton. You decided that, hey, it is time for me to relocate back to your hometown and move to your rental property, but you're worried about capital gain tax. What is the tax implication here? Because you're now moving back into a rental. We know that you would have reported income and expenses incurred on this Hamilton rental property for the last 5 years. And if you've claimed capital cost allowance on this property, you would have to take the recapture on the capital cost allowance that you've claimed into income the year that you move in. We discussed this before. Now, you would also need to report the capital appreciation on your personal tax return the year that you move in. However, if you did not claim any capital cost allowance on this rental property, there is no recapture tax, as we discussed before, as you've never claimed CCA on this rental. You can file the Election 45-3 to designate this rental property as your primary residence, as long as you didn't own a primary residence for up to 4 years before you moved in. You can defer at least 1 year of capital gain because you own the rental property for 5 years. You can also get 4 additional years of capital gain tax-free as a result of this election to be filed. Let me just clarify. Year 1, you don't own any property except the Hamilton rental property. Year 2, you also do not own any property except your Hamilton rental property. Year 3, year 4, and then year 5, you decide to move back in. So in year 1 to 4, because you do not own any other property that you currently live in, you don't have a primary residence. And year 5, if you move in and file the 45-3 election, you can then claim designated property and claim 45-3 election on year 1, 2, 3, and 4 and shelter the capital gain that you have accrued on that property, provided that you never claim any capital cost allowance on that particular property to offset against the net rental income. Now, so this is really cool because it allows you to save 4 additional years of capital gain tax. But that's a different story when you own a primary residence within that last 4 years. You would still be able to defer the capital gain tax on this rental property in Hamilton until you sell it with this election. In conclusion, don't claim capital cost allowance if you have plans to move into a rental property. Now, let's look at some commonly asked questions. Can you point out the right tax form to file? Well, this is an election. It doesn't really have a prescribed form. You just need to write your intention on a letter and send it together the year that you sell your property together with your tax return. Second question, if I claim capital cost allowance in all 5 years owning the rental property, am I still able to claim the capital gain exemption for the past 4 years, or does the exemption only apply if you haven't claimed any CCA? Well, unfortunately, as I mentioned before, the only time that this 45-3 election would be effective is if you've never claimed capital cost allowance. So there is a tax implication on capital gain, and there is tax implication on the recapture on that you have claimed. Now, question 3, in your example, do you recommend appraising the rental property at the end of year 4 to ensure that the amount is not taxed on? Or do you simply take the difference between purchase and sale and divide by the years you own it, and then not pay tax for the first 4 years? Well, CRA does require you to take the average approach every time you use primary residence exemption. So the answer is that you would have to take the capital gain and divide by the number of years of ownership, and each year you would have an average capital gain per year. And from there, the first 4 years, if you designate that first 4 years as your primary residence, then the first 4 years would be exempt. You take the 4 years multiplied by the average gain, and that would be the exempted amount. So I hope I answered all your questions, and I hope you guys all learned something new today. If you like our video, make sure that you hit the like button below. And if you have not subscribed to our channel yet, make sure you hit the subscribe button below and turn on the little notification button below. Until next time, thank you for watching.